Picture this. Your personal wealth doesn't slowly decline. It vanishes almost instantly. Not because the stock market imploded, but because the asset holding most of your money, your luxury home, is shedding value by the minute. For decades, people were assured that real estate was a one-way bet, especially in America's most prestigious neighborhoods. That long-standing belief is now cracking apart. What we're seeing today is an unprecedented adjustment in the high-end housing market, one that's pushing sellers into panic and leaving buyers frozen with fear. Across the country, from Florida's sun-soaked estates to Texas's booming tech corridors and California's elite coastal enclaves, homes are sitting unsold. Inventory is swelling, and prices are sliding at a pace not witnessed since the 2008 financial crisis. In this episode, we're hitting the road to explore 10 U.S. cities where the promise of luxury living has transformed into a serious financial liability. We'll expose the hard numbers many real estate professionals would rather keep hidden, including a jaw-dropping 60% collapse in sales in one West Coast city that earns the top spot on our list. So strap in, because if you're considering buying a high-end property in any of these markets, you could be stepping directly into a falling knife. Before we start this journey and see the damage up close, take a second to like the video, subscribe to the channel, and share your thoughts in the comments. Do you think prices still have further to fall this year? Now, let's drive straight into the storm. Number 10 on our list, Nashville, Tennessee. Our journey begins in the vibrant heart of Music City, a place that surged in popularity during the pandemic, but is now grappling with a harsh reality check. Nashville used to be a favorite among real estate investors, attracting cash buyers nationwide who were drawn to its southern charm and appealing tax incentives. But for the luxury market, the music has definitely stopped. Drive through upscale neighborhoods like Green Hills or Belle Meade, and you'll notice multiple for sale signs lingering for months, gathering dust instead of offers. The inventory of high-end homes has exploded as builders pumped out luxury condos and spec houses, betting on a demand that simply hasn't materialized. Recent figures from Redfin show that the supply of luxury properties in Nashville has soared over 30% year over year, creating a huge surplus that sellers are struggling to move. Desperation is clear in the price reductions. Nearly 1 in 4 luxury listings has dropped their asking price in hopes of attracting a buyer. Homes are sitting on the market for dangerously long stretches, with many million-dollar properties lingering for 90 days or more without serious offers. Realtor.com reports that pending sales in the top 5% of Nashville's market have fallen by double digits compared to last year. Meanwhile, the absorption rate, which measures how quickly homes are selling, has collapsed, signaling a strong buyer's market and leaving sellers with almost no leverage. This is no longer a seller's paradise. It's a financial trap for anyone who purchased at the peak, expecting 20% annual gains. The influx of wealthy buyers from the coasts has slowed to a trickle, leaving an oversupply of pricey homes that local buyers simply can't afford. If you own luxury property in Nashville, the window to sell at a premium has likely already slammed shut. Number 9. Phoenix, Arizona. Next, we're heading west into the desert to a city that became the poster child for the remote work boom. But now it's leading the luxury housing crash. The heat in Phoenix isn't just in the sun, it's in the rapid cooling of what was once one of the hottest high-end markets in the country. During the pandemic, prices nearly doubled as wealthy buyers fled crowded urban centers. But today, many of those same buyers are finding themselves underwater. Investor activity, which drove the surge, has evaporated almost overnight, with institutional buyers exiting faster than they arrived. According to the Cromford report, luxury home inventory in the Phoenix metro is piling up at a staggering pace, far outstripping the weak demand. The median sale price for luxury homes has dropped roughly 10% from its peak, wiping out hundreds of thousands of dollars in equity for recent purchasers. Zillow reports that price cuts here are among the highest nationwide, with sellers slashing $50,000 or more just to attract a showing. Meanwhile, new mortgage applications for jumbo loans have plummeted nearly 40%, showing that financing for these pricey desert properties has effectively dried up. The Wall Street Journal highlights Phoenix as experiencing one of the steepest reversals in the country, particularly in luxury real estate, as tech sector slowdowns hit the wallets of potential buyers. On top of that, Short-term rental investors who purchased luxury homes to flip into Airbnbs are now dumping properties onto the market after booking rates collapsed. Vacancy rates are climbing in these high-end investment properties, forcing owners to sell into a market already overflowing with supply. What you're seeing here is a textbook boom and bust cycle unfolding in real time, and there's no bottom in sight. If you think it's only the desert sun scorching homeowners, take a look at their rapidly falling property values. Number 8. Las Vegas, Nevada. Our journey now takes us to the entertainment capital of the world, where betting on luxury real estate is turning into a high-stakes loss. Las Vegas has always been a volatile market, but the current downturn in high-end homes is particularly brutal, fueled by a sudden pullback of speculative capital. Not long ago, it seemed like every other house was selling above asking price. Today, open houses in prestigious neighborhoods like Summerlin and Henderson are quiet, almost eerily so. The luxury market here relies heavily on second home buyers from California, but with economic uncertainty in the Golden State, that critical pipeline has dried up. According to Las Vegas realtors, luxury home sales have fallen more than 25% compared to last year. Meanwhile, inventory for single-family luxury homes has swelled to levels not seen in years, creating a backlog that could take over a year to work through at the current pace of sales. Asking prices are dropping sharply, with actual sale prices now coming in well below list price for the first time in a long while. Redfin data shows that over 30% of sellers are reducing their prices, a clear signal of stress in the market. Foreclosure filings, while not yet at crisis levels, are ticking up among high-end properties, hinting that some over-leveraged investors are running out of breathing room. Even cash buyers are holding back, waiting for another 15 to 20% drop before making a move. The glitter and glamour of Vegas can't mask the hard truth. Rising holding costs and falling values are squeezing owners from both sides. Right now, the market is playing against you, and the cycle is coming out on top. Think twice before placing your chips on a luxury property in Sin City. Number 7. Seattle, Washington. Now we're heading north into the Pacific Northwest, arriving in a city where the luxury housing market is being dragged down by the tech industry's slowdown. Seattle's high-end real estate is closely tied to the fortunes of companies like Amazon and Microsoft, and as their stocks wavered, so too did the buying power of affluent tech workers. Stroll through neighborhoods like Queen Anne or Mercer Island, and you can feel the shift. Luxury buyers are worried about job security instead of hunting for upgrades. Sales of luxury homes have plummeted, with some reports showing year-over-year declines exceeding 30%. According to the Northwest Multiple Listing Service, the inventory of homes over $2 million has surged, leaving sellers competing for a shrinking pool of serious buyers. Properties are now staying on the market twice as long as they did just a year ago, killing the urgency that once sparked bidding wars. Luxury prices are softening, with median prices in several high-end King County zip codes slipping compared to last year. Brokerage data shows that fewer than 20% of luxury listings are receiving multiple offers, a stark contrast to the frenzied market of previous years. Higher interest rates are making jumbo loans more expensive, adding another hurdle for buyers of these pricey homes. Redfin has flagged Seattle as one of the fastest-cooling luxury markets in the nation, especially at the top end. Even rental demand is weakening, meaning owners can't simply turn unsold mansions into income-generating properties to cover mortgages. Here, the rain isn't the only thing dampening spirits. The rapid erosion of equity is fueling panic among recent buyers. If you're hunting for a deal in the tech capital, patience is key. Prices are likely to drop further. Number 6. Honolulu, Hawaii. Next, we're taking a trip across the Pacific to the tropical paradise of Honolulu, where the luxury real estate market is caught in a perfect storm of economic pressures and environmental risks. While it may seem like paradise is immune to downturns, the latest data from Oahu shows that even the most idyllic locations have a breaking point. Owning a luxury home here has become prohibitively expensive, not just because of rising interest rates, but also due to an escalating insurance crisis that's making many properties either uninsurable or astronomically costly to protect. Mainland buyers, who traditionally fuel Hawaii's high-end market, are pulling back amid economic uncertainty and soaring costs for travel and property upkeep. According to the Honolulu Board of Realtors, Luxury single-family home sales have dropped more than 20% over the past year. Meanwhile, median prices for luxury condos have been volatile, with some months showing double-digit percentage declines while inventory sits stagnant. Rising condo fees and maintenance costs in upscale buildings are also deterring buyers who don't want to inherit a money pit. Local brokerage data shows that months of supply for luxury estates have ballooned, shifting leverage heavily toward buyers willing to negotiate aggressively. Japanese investors, who historically played a huge role in Hawaii's luxury market, are largely absent due to the weak yen against the dollar. Redfin reports that Honolulu currently has one of the slowest turnover rates for high-end properties, meaning any purchase could tie up capital for a long time. Here, the dream of owning a beachfront mansion is clashing with the realities of rising costs, eroding shorelines, and falling property values. In Honolulu, the view may be priceless, but the financial fundamentals beneath it are crumbling. If you're considering buying, make sure you check insurance premiums carefully before even looking at listings. Number 5. Miami, Florida. Now we're back on the mainland, heading south to Miami, a city that seemed to defy gravity for years but is now plummeting back to reality at a startling pace. The Wall Street South boom drew billions in wealth, yet soaring condo fees and skyrocketing insurance premiums are now triggering a wave of selling. You can't talk about Miami without mentioning the condo crisis. Older luxury buildings are facing huge special assessments to comply with new safety regulations, forcing owners to offload units at steep discounts. Luxury condo inventory in Miami-Dade County has reached levels not seen in years, creating an oversupply that's dragging prices down across the board. According to the Douglas Elliman report, luxury sales volumes in Miami have fallen sharply, dropping more than 25% year over year in some quarters. The era of cash buyers snapping up properties sight unseen is over. Now, it's common to see listings sitting unsold for 6 months or more without a single offer. Insurance premiums for luxury waterfront properties have tripled or even quadrupled, making the monthly cost crushing, even for the wealthy. Zillow data shows an increasing number of listings with price reductions, particularly in the $1 million to $3 million range. Foreign buyers, especially from South America, who once propped up the Miami market, are scaling back due to currency devaluation and economic uncertainty. Redfin warns that Florida metros, including Miami, are at high risk of a price correction, as home prices are increasingly out of sync with local incomes. The party in South Beach is ending, and the cleanup comes in the form of depreciating assets and soaring carrying costs. If you buy here now, you're not just buying a home, you're taking on a massive financial liability wrapped in sunshine. Number 4. New York City, New York. Our journey now takes us to the bustling streets of Manhattan, where the luxury real estate market is struggling to keep pace. The city that never sleeps is currently seeing a slow-moving high-end housing sector, weighed down by high interest rates and changing lifestyle preferences. There's a clear oversupply of luxury condos, especially in new developments built during the era of cheap money, projects now facing difficulty selling units. Wall Street bonuses, historically a major driver of springtime luxury purchases, have been underwhelming this year, removing a key source of demand for multi-million-dollar apartments. According to the Ocean Report, which tracks contracts over $4 million, Manhattan's luxury market activity remains well below historical averages. Add to that the steep mansion tax and high closing costs, and even buyers who might be interested are hesitant, unsure about where prices are headed. StreetEasy data shows that a significant portion of luxury listings has been sitting on the market for more than 180 days. Resale values are also taking a hit, with many sellers realizing losses compared to what they paid 5 or 10 years ago. Reports from Miller Samuel and Douglas Elliman confirm that high inventory levels combined with slow sales are putting downward pressure on price per square foot. Remote work has permanently reduced the need for many executives to maintain a city pied-à-terre, eliminating a huge segment of potential buyers. While some New York sellers remain stubborn, market realities are forcing six-figure price reductions just to generate interest. Even a prestigious Park Avenue address can't escape the pull of falling prices. Watch for further cuts as developers grow increasingly desperate to clear their books. Number 3. Los Angeles, California. Heading back to the West Coast, we arrive in the turbulent Los Angeles luxury market, where a new tax law has essentially frozen ultra-high-end real estate. The mansion tax, previously known as Measure ULA, levies a huge transfer tax on properties sold for over $5 million, and the impact has been dramatic. Transaction volume has collapsed as sellers pull homes off the market or try to structure deals to avoid the tax, leaving the market paralyzed and values dropping fast. Walk through neighborhoods like Bel Air or Beverly Hills, and you'll see activity that looks like a ghost town compared to the frenzied pace of past years. Data from the Multiple Listing Service shows that luxury home sales in Los Angeles fell by over 40% immediately after the tax went into effect. Inventory is sitting stagnant because buyers refuse to pay inflated prices that factor in the tax, while sellers won't absorb the cost themselves. Famous estates are now selling for millions below their original asking prices as the market recalibrates. Redfin reports indicate that median sale prices in high-end zip codes are trending downward as the gap between buyers and sellers widens. On top of that, many wealthy residents are relocating to states with lower taxes, like Nevada and Texas, shrinking the pool of potential buyers for these mega mansions. Insurance companies are also pulling back from high fire risk areas in Los Angeles, making it extremely difficult to insure hillside estates. Douglas Elliman reports confirm that Los Angeles has seen the steepest decline in luxury sales activity of any major market they track. No amount of Hollywood glamour can fix a market where taxes and insurance costs make ownership punishing. If you have millions to spend, Los Angeles is handing you every financial reason to look elsewhere. Number 2. Austin, Texas. Our second-to-last stop takes us to Austin, a city that arguably experienced the nation's biggest housing bubble and is now facing its harshest burst. During the pandemic, buyers lined up around the block, pushing home prices up 50% or more in record time. Today, that frenzy has reversed, leaving the city awash in inventory as tech workers grapple with layoffs or mandatory returns to the office. Builders raced to complete thousands of new units just as demand evaporated, flooding the market. According to Redfin, Austin consistently leads the country in year-over-year price declines, with luxury homes taking the brunt of the drop. Inventory has surged over 40% compared to last year, creating a massive oversupply, while Zillow data shows one of the highest rates of price cuts nationwide, as sellers chase the market down week after week. Luxury properties are lingering 3 times longer on the market, trapping owners who bought at the 2022 peak with negative equity. Realtor.com reports indicate that migration patterns fueling Austin's boom have reversed, with more people leaving the city than moving in. Institutional investors who previously poured money into the area are now liquidating portfolios, adding even more pressure to an already saturated market. For latecomers who bought at the top, the Silicon Hills dream has become a financial nightmare. Prices are free-falling, and the bottom is nowhere in sight as the tech sector continues its correction. In Texas, trying to catch a falling knife in the luxury market can mean bleeding equity for years. Number 1. San Francisco, California. We've finally arrived at the most striking and devastating stop on our road trip, the epicenter of the luxury housing collapse. San Francisco is caught in a vicious cycle of urban decay, soaring office vacancies, and the exodus of its wealthiest residents, sending property values plummeting. This downturn isn't just a typical market correction, it's a fundamental restructuring of the city's economy and desirability. Luxury condos in downtown San Francisco are now selling at prices reminiscent of 2015, wiping out nearly a decade of appreciation. Compass reports that luxury home sales volume has dropped sharply, with some quarters seeing declines exceeding 30%. Active listings are piling up as tech millionaires and billionaires relocate to tax-friendlier states, leaving a glut of high-end properties on the market. Redfin data shows that San Francisco sellers are far more likely to take a loss than anywhere else in the country, with nearly 1 in 5 selling at a hit. Median sale prices for luxury homes have dropped double digits year over year, a shocking reversal for a market once considered untouchable. Record-high office vacancy rates are further undermining the local economy that supports these high-end properties, while major retailers and businesses are fleeing the city center, reducing the appeal of owning luxury real estate nearby. The California Association of Realtors notes that housing affordability remains a challenge, but at the top end, demand has all but vanished due to concerns about quality of life. San Francisco now stands as the nation's worst-performing luxury market, battling both economic headwinds and a crisis of confidence. It serves as a stark reminder: no city is too exclusive or expensive to avoid collapse. If protecting your capital matters, this is one market to steer clear of until the dust settles. Having traveled across the country, we've seen the unmistakable signs of a luxury housing market under strain, from Los Angeles' tax-burdened hills to Austin's oversupplied streets, and now San Francisco's hollowed-out core. The message is clear: prices are falling fast, and this is more than a simple correction. It's a warning for the wider economy that the era of easy money has ended. If you found this analysis insightful, hit the like button, share it with anyone planning to buy a home, and subscribe for more transparent financial breakdowns. Drop a comment below and let me know which city you think will crash hardest in 2025. Thanks for watching, and I'll see you on the next road trip.